It feels like the hope is gone. Retail traders are dialing ADA's sentiment to its lowest in 5 months, yet whales are quietly scooping up over 200 million ADA near the .80,000 support zone. Could this be the calm before a contrarian surge? You can see it in the discourse, you can sense it in the choppy candles. The vibe around Cardano has curdled into something darker than simple boredom. Retail sentiment has slipped to its most bearish level in 5 months, and the loudest voices online are either dunking on ADA or ignoring it entirely as they rotate into whatever just printed a face-melting pump this week. But what if that icy mood is not a reason to hide, but the exact setup long-term winners dream of? What if the negative noise is simply the camouflage for accumulation? Today, September 6, 2025, I'm going to show you precisely why this disconnect between emotion and evidence might be the opportunity that patient investors wait years to see. Let's start with the raw, uncomfortable truth that's dominating the headlines. Multiple on-chain and market intel reads over the last 48-72 hours say the same thing. The crowd around ADA has turned overtly bearish. Sentiment's data shows the bullish to bearish commentary ratio falling toward bet 1.51, its weakest point since April, exactly when many would expect a capitulation-style flush. And yet here's the twist. Right as that sentiment trough formed, ADA bounced about 5% off late August lows. That's not my opinion, that's the tape. It doesn't mean the bottom is guaranteed, but it does tell a story that deserves your attention. Sellers may have swung hardest when conviction was thinnest, and price responded with a reflex up move. On days like today, the story remains the same. Retail is fearful, but price refuses to die. So what does that setup mean in plain English? Historically, when the crowd gets this one-sidedly negative, two paths dominate. Path 1, sentiment is right and continues to lead price lower as liquidity evaporates. Path 2, sentiment is late, reactive, and the despair simply hands a window to larger players who prefer to buy from panic sellers. Right now, much of the real-time analysis points to that second path. While retail commentary sours, whales are selectively active, price structure is defending a make-or-break zone near 0.82 cents, and the market keeps rejecting deep sub-0.80 breaks. Even mainstream market desks are calling out the divergence, bearish crowd, but a 5% lift in an open lane for accumulation. That is the definition of a contrarian inflection to watch. Now I want to be absolutely fair and build the bear case first because that's the lens most viewers are wearing today. Bears will argue that sentiment hasn't crashed, it has finally normalized. ADA, they say, is just losing the war for attention. New narratives cycle every week. Liquidity chases speed and hype. If Cardano can't command headlines, capital won't stick around. They'll point to large transfers and occasional whale sell-offs, like the 50 million ADA that moved over 48 hours, as signs that even bigger pockets are trimming exposure, forcing ADA to cling to that 0.82 shelf. They'll warn that if 0.82 breaks decisively, and 0.80 goes with it, the next magnet could be the mid-0.70s, where the previous range nursed buyers back in June. In their view, ADA monopolizes patience, not performance. If you adopt that lens, the smartest move is to ride momentum elsewhere and avoid being the last one holding the bag. That bear narrative has surface logic, and if support fails, price will validate it. But here's where the bull case, on-chain nuance, and basic market structure step in. Number 1, the capitulation then rebound sequence into a key support is a classic pattern at the end of a sentiment cycle. We saw the lowest crowd optimism in 5 months, then price moved opposite to the crowd's view. Sentiment has highlighted this dynamic repeatedly. The crowd leans hard one way, and the market rips the other. That doesn't promise a moonshot, but it fits the blueprint of how squeeze starts and mean reversions often look. Number 2, several desks and outlets have flagged active accumulation footprints around that 0.85 area, even while most social chatter is de-risking. This quiet bid doesn't trend on X, but it shows up in the scroll of discrete inflows, aggressive wick buys, and persistent defense of the same zone. Number 3, once retail exits emotionally, supply dries up faster than people expect, and a relatively modest push can reclaim resistance bands and force late bears to cover. Let's zoom into the levels because levels tell you where emotion meets money. The line in the sand remains 0.82 cents. That's the immediate demand zone the market keeps testing and so far respecting. On the top side, the first real test sits just under door long 290. Call it the door long 290 pocket, where recent bounces have stalled. Clear and hold above door long 290 on convincing volume, and you shift the conversation from dead coin drift to base building breakout. Several technical reads floated in the last 24 hours are even eyeing door long 297 as a pragmatic first push if momentum rotates, with an extension toward the one door long 290 $15 region if the market can string higher lows and convert prior supply into demand. Again, these are if-thens: hold the floor, reclaim the ceiling, pressure the shorts, invite sideline capital back. That's the staircase, step by step, regardless of memes or hate likes. But wait, you might say, how do I reconcile headlines that claim whales dumped with headlines that imply whales are accumulating? Welcome to real markets. Whales are not a single mind, they're a set of large actors with different timeframes. You can have one cohort taking profits into $1 retest weeks ago, another distributing into strength near 0.90 cents, and a third silently layering bids around door long 82. What matters is the net effect at price. In the last 2 days, even as chatter went cold, the tape showed steady rescue wicks and no decisive loss of that $0.82 band. That doesn't prove accumulation by itself, but combined with the sentiment trough and the 5% reflex higher, it sketches an accumulation-friendly canvas. It's the kind of tape that punishes impatience and rewards those who buy fear with risk controls. Let's also put ADA in its 2025 context. Cardano is not a microcap that triples on a tweet, and it isn't trying to be. It lives in that awkward middle ground, big enough to feel slow, still early enough to be underestimated. Coverage this week keeps contrasting ADA's plodding reputation with faster-moving narratives, but the data doesn't show abandonment, it shows rotation and frustration. Active address momentum has ticked higher week over week, while larger holders still command a meaningful chunk of supply, and institutional custody growth is up on the year. The caution flag in some of that analysis is a high NVT, suggesting valuation sensitivity if throughput doesn't pick up, but that's exactly why the market tends to reprice Cardano in bursts rather than smooth climbs, accumulate in boredom, re-rate in catalysts. If the floor holds while crypto's macro liquidity stays constructive, it doesn't take exuberant flows to push ADA back toward the round dollar. Speaking of catalysts, you'll see plenty of crosstalk this month about rival ecosystems, ETF chatter, and new PayFi narratives. It's tempting to frame those as zero-sum Cardano loses if X wins, but in practice, crypto capital rotates in cycles. ADA has historically done best when it exits accumulation right as attention pivots back to fundamentals, tooling improvements, throughput discussions, roadmap milestones. Regardless of which seaside meme coin is trending, if ADA's base holds and sentiment remains washed out, even a modest news burst can spark a retest of overhead supply. And that's the nuance most bears miss. You don't need a pie-in-the-sky headline to go from 0.84 to 0.97 cents. You need buyers to stop stepping aside and sellers to run out of ammo. Sentiment is already signaling the second part. Runners, let's get tactical with how this story plays out on a chart you can follow. If you're watching the 4-hour or daily candles, the tells are straightforward. First, look for higher lows inside the 0.82-hour range. That says the bid is tightening. Second, watch for wicks that pierce 0.82 only to close back above it. Classic absorption. Third, on any push toward $0.872, if you see expanding volume on green candles into that shelf, you have evidence that supply is getting eaten, not simply avoided. Close a daily candle through 0.90 cents, revisit it as support, and you've changed state. From there, the magnet becomes the 0.97 callout, and then the psychological $1. Take it one battle at a time. Now, to address the elephant that everyone tiptoes around, is Cardano a dead coin? It's a rhetorical cudgel that resurfaces whenever ADA lags a hot rotation. But the real world doesn't answer that question with snark, it answers it with flows. If the chain's users stick, if devs continue to iterate, and if larger holders keep positioning during fear, none of that looks like dead. What it looks like is a patient asset in a market that rewards impatience until it doesn't. Remember, bottoms don't ring bells. They look like boredom, conflict, and disbelief. They look like 5-month sentiment lows and 5% rebounds that no one trusts. That's why contrarian setups feel uncomfortable, because they are. Still, prudence matters. The invalidation level is simple enough that you don't have to guess. Lose 0.80 on expanding sell volume, fail to reclaim it quickly, and the base thesis is compromised. In that case, expect price to search for buyers lower and sentiment to get even uglier before it gets better. If you're positioning around a contrarian view, define your risk. If you're a longer horizon investor, remember that time in the market beats timing the market, but only if your thesis is rooted in evidence, not hope. Today's evidence says sentiment is washed out, price is sticky, and larger holders are not uniformly exiting in a panic. Manage risk, but don't let the crowd's mood write your plan. So where does that leave us for the next 1 to 2 weeks? The base case is a sentiment mean reversion, with price probing the upper band of the range. Think of it like this: defend 0.82 cents, and attempt a daily close above the shelf that's rejected the last few pushes. If that unlocks, the path to 0.97 opens, and the temptation for sideline traders to chase a round number tag at $1 grows. From there, the 3 to 6 week upside scenario extends toward $1, a 77, $115 if the breakout sticks, higher lows hold, and broader crypto risk remains constructive. Those aren't moonboy targets, they're what the recent technical workups have flagged based on structure, volume, and the way ADA historically exits fear pockets. Let me also address the comparisons and distractions that inevitably show up in your feed articles, ranking ADA against faster chains or touting shiny new tokens with 100x promises. That content exists to harvest attention during boredom. It's not that alternative plays can't outperform, many will. It's that your decision on ADA should stand on ADA's evidence, sentiment extremes, defended supports, and telltale accumulation behavior. If you believe in the asset's long-run roadmap, these are the precise windows you get paid for enduring. If you don't, then you're not a contrarian. You're just conflicted. Make a plan either way. Bring it all together, and here's my view, stated plainly. Today's market is offering a rare alignment, a measurable crash in retail sentiment, visible resilience at a critical support band,
and mounting signs that larger hands are active while the crowd is exhausted. That is a textbook contrarian backdrop. It doesn't guarantee outcomes, nothing does, but it does flip the odds from why bother to watch closely. If we hold 0.82, trap late shorts and reclaim 0.90 with authority, the squeeze fuel is right there. The same voices that declared ADA done at 5-month sentiment lows will be explaining a $0.97 tag and a $1 knock as if it were obvious in hindsight. That's how markets work. They punish certainty and reward preparation. So here's how I'm navigating this moment. I'm separating emotion from evidence. I'm respecting 0.82 as the pivot, invalidated if lost, validated if defended. I'm watching for higher lows on the 4-hour and a decisive high-volume daily close through 0.90, and I'm paying more attention to the quiet footprints, stubborn wicks, persistent bids, and that subtle 5% bounce in the exact week sentiment hit the floor, than to the loud takes farming engagement. In other words, I'm doing what smart money has always done: buy when fear peaks, add on confirmation, exit if the thesis breaks. Do the same in your own way, with your own risk, and let the tape, not the timeline, guide you. If you've made it this far, I want your read. Is this just a pause before another leg down, or the precise kind of sentiment wash that precedes upside surprise? Tell me in the comments, are you with the crowd or are you with the data?